Hi, my name is Adam Goldberg. I'm a wealth advisor at Sachs. We're an independent registered investment advisor offering strategic long-term financial and estate planning built on trust, integrity, and meaningful client relationships. As a wholly owned subsidiary of Sachs LLP, an accounting, tax, and advisory firm, Sachs Wealth Advisors provides a wide range of solutions to help prepare for your future and enhance your financial position at every stage of life. I am joined by Paulo Lupescu, a highly regarded speaker from Dimensional Fund Advisors, a premier global investment firm managing about $675 billion in assets for institutional investors and clients of select financial advisors. At Sachs, we incorporate Dimensional's expertise to help construct our clients' portfolios. Apollo has a unique ability to convey the technical aspects of investing in a manner that is understandable and relatable to investors with various levels of financial acumen. Apollo's unique insights will provide clarity into a complex issue, leaving you with a better understanding of the link between the market and politics, as well as practical advice for investors looking ahead. Apollo will help answer questions such as, will the ongoing market rally slow down or perhaps gain more steam based on results in November? Which sectors might benefit and which might be negatively impacted by the results? And ultimately, should investors make changes to their portfolios based on the election outcome, or is it better to stay the course? Apollo, with that, I'll hand it over to you.
Well, Adam, first of all, thank you so much for the invitation to be part of this webinar, and thanks to everyone for taking the time to attend. And it's certainly a very, very hot topic, not just because of what is on the news right now, but I think it's something that's going to pick up steam. And I find that so many people are actually curious about exactly what you mentioned. Based on the election outcome, should I be doing something with my money? What is the relationship between politics and the markets, and how to navigate as an investor these waters? And I think it's a really important issue. We spent some time looking at it, and I'm going to start with more of a general comment, more of a personal observation that I think eventually will tie into to our discussion. And what I've observed is that when it comes to politics, it is something that really gets very heated very quickly. And in fact, as a personal story, I ended up going on a little boat trip for about a week, and there are about 8 couples, and there were 2 rules that we established as we walked on that boat. Is number 1, there's no whining and complaining about this is not cold enough, whatever. No, we just enjoyed the trip. And number 2, no politics. We're not going to talk any politics because it triggers these strong emotions. And ultimately, I will not be able to change somebody else's mind. We all liked each other, but we know that there's conflict when it comes to politics. So my first comment to you is an acknowledgement that politics touches our deeply held beliefs. In fact, our core identity as individuals. And because of that, it tends to be very emotional. And I'm perfectly okay with that because emotions are what makes us human. There's nothing wrong with the emotions. And in fact, I would encourage people to act on those emotions when it comes to elections. The easiest way is go vote, get involved in a campaign, whatever helps you feel better. What I'm here to do is not really make you feel good or bad about your political views, because what I found over and over and over again is that successful investors are able to acknowledge these emotions and at the same time disentangle them from investment decisions and make those investment decisions based on much more pragmatic reasons, such as looking at data and evidence. So what I'm going to do today is not really try to do political commentary or any of that. No. I'm not there to do that. I'm just here to look at data. What do we know economically about this connection between the markets and politics? And to really do it justice, I'm actually going to go back to way back to when the connection started between the markets and the politics. And to really get a sense of that, we have to go all the way back to the founding fathers. And in fact, what was interesting as I dug into this a little bit, I found out that connection between the government and the markets, in fact, goes back to about 1784. And 1784 is the year when Bank of New York was established. And that's right there in New York, in your backyard. And what was interesting is that the one of the founding members of the bank was none other than Alexander Hamilton. I mean, he was in fact the person who one of the folks who wrote the charter for that bank. And the reason I say it's the first connection is because in 1789, that's 5 years later, that's when the U.S. government took out its first loan from the Bank of New York, which was founded by one of the founders being Alexander Hamilton. And just as a matter of curiosity, there are 700, I think, and 23 shares of ownership in that bank. Alexander Hamilton owned 1.5 shares. And it turns out that for you folks who have seen Hamilton, the musical, Aaron Burr owned 3 shares, so twice as many as Hamilton in Bank of New York. But the reason I mention this is because that was the first time that the U.S. government took out a loan from a bank, and it was $200,000, and it was designed to pay the salaries of the president, George Washington, and the members of Congress. And the reason I think it's also so interesting is because Bank of New York was the very first stock traded on the New York Stock Exchange. The New York Stock Exchange, in fact, was formed in 1792, and the one stock that traded was Bank of New York. So certainly the idea is that over the, we've seen this connection between the government and politics for many, many years. So there's nothing really new there. But what's changed over time is the stock market, and we're here to talk about investing. So one of the things that I want to touch on is now that you have the stock market and the government probably more connected, is there something that investors should do, given that one particular administration might favor parts of the economy versus the others? In other words, one of the comments that I've heard quite a bit is that given the current administration or given the previous administration, whatever might come next, should we make a play with our money and perhaps emphasize some companies, some sectors of the market that might come in favor, or should we actually pull back and not invest in ones that might be out of favor? And I think it's a really interesting question because, as we know, different administrations come with different priorities. And I'm going to start with just a case study looking at what if you're applying that strategy in the real world? What does the data suggest? As a case study. And I'm going to use the previous administration. And if you remember back about 2017, in early 2017, there was talk of promoting the U.S. manufacturing. The idea that we want to produce more locally, and we're going to try to support these businesses by, in fact, making it harder for international sellers to sell here in the U.S., international producers to sell in the U.S. And the case study that I'm thinking about has to do with steel. And in the early days, there was this idea that perhaps we need to protect the steel industry by imposing some tariffs. And if you're an investor at that point, one of the thoughts might be, well, let's look at the U.S. Steel, which actually carries the name of the industry, as a company to buy, because it is now a company that might actually benefit from the support of the U.S. government. And if you're an investor and you look at U.S. Steel, you say, well, it might make sense to buy that stock. So if you look at the performance of that stock, as these discussions were going on, you do see that there was an uptick in the price per share. So as an investor, yes, you made some money after the initial drop. When there was this talk of the tariffs, there was a bump in price. And it turns out that in March of 2018, the U.S. government did impose trade tariffs, and that clearly benefited U.S. Steel. So as an investor, the narrative goes that, well, now I got to buy U.S. Steel because that is the company that will have an advantage in the marketplace because of these tariffs. But what's so interesting is that if you look at what happened to the price of the share of one share of U.S. Steel, what you see is that for the remaining of the previous administration terms, that value tanked. You would have lost the majority of the value in that investment, even though you do have the government and tariffs backing you up. So just because the government gets behind a company or a sector, it doesn't necessarily mean that's going to be a success for investors. And it's a clear case study here that it doesn't have to be. The company itself makes a big difference. What products they have, how they sell, quality, a lot of things matter. And in this case, it turns out that even with those tariffs, that did not benefit investors at all. So again, if you hear whatever administration might come next, that one sector might be favored or not, that does not mean that you ought to jump onto it and then buy that stock. Now, what about a sector that might fall out of favor? And for the current administration, one of the industries that really hasn't been really promoted as like we're very friendly to it has been the oil industry, because there's so much talk of solar and renewable energy, green. That's great. But what about the good old fossil fuel industry? What if you take a company that is in that business that at that point might seem at a disadvantage, and it might not seem like a good investment because, again, it's out of favor with the current administration, supposedly. Well, you can look at Exxon, and when you look at Exxon during this period of the current administration, you see that there was a significant increase in the value of the price per share for Exxon. So the story goes, and in my opinion, that's sort of the right way to think about it, is that when you look at a sector or a company that might be in or out of favor, and as an investor, you think about purchasing or selling that, I'm not sure that the administration policies are the right basis for that decision. And I think that you're better off just kind of looking at the dynamics of each company, and the government certainly influences that. It just doesn't seem to be a primary reason for the performance of the stock. And we'll come back to this idea over and over and over again. But we are closer to the elections, the presidential election in elections in November, and I think there is a legitimate question on how this might impact the stock market and the economy. We've looked at this, and it's quite interesting because, as I said, it's very emotional. And I would say that in November, about half the country will be very disappointed. They'll be feeling like they're let down. They need to sell everything and move to Canada. And the other half will be ecstatic. So the perceptions that people will have about where the economy is going and where the stock market's going will really, in my opinion, be driven by their emotions. Now, what about the data? What does the data suggest with respect to presidents, their political affiliation, their priorities in office? What do we know when you look at data? And let's start with just a big picture. It's an election year, and you hear so much about markets don't like uncertainty, that the elections are adding additional uncertainty, and that certainly cannot be good. Well, if you look at the history of the U.S. stock market, we have about 100 years of data. In the span of this 100 years of data, we have had roughly about 24 different presidential elections. So let's start with that. We are in an election year. What does it mean for the markets? Is this additional uncertainty changing the dynamics of the market? Because even as we say, this is the most important election ever, every single 4 years, we kind of hear the same thing. It's the most important election ever. But what does the data suggest in terms of looking back at these 24 different election years? And to set the stage, I just want to kind of maybe give you a quick perspective of the U.S. stock market in general. If you look over the past 100 years, irrespective of being an election year or not election year, what you see is that roughly, these are rough numbers, 1 in 4 years, the market goes up, it's positive. I'm sorry, it's negative. Well, let's start with a positive. 3 in 4 years, the market goes up, so there's a positive outcome. You make money in the market, and here the market being the S&P 500, which means that 1 in 4 years, actually the market drops. So if you think about the half or full glass or whatever you want to call it, half full or half empty, again, what we see is that 75% of the years that we have data, we see positive outcomes in the market and about 25% negative. And I want to start there because that is our benchmark, our yardstick. If you just simply look at the stock market without being an election year, that's sort of the breakdown of positive and negative years. Now, if we now focus solely on these 24 presidential election years, the question is, what's the breakout now? Do we see more negative years or do we see fewer negative years? What's the split between positive and negative? And when you look at the numbers in these 24 different presidential elections, what's so interesting is you see that 4 out of the 24 years, the market did drop. So we did have a negative outcome in the market. But what's fascinating is that the overwhelming majority of the years, 20 out of the 24 years when we had an election, the market actually went up. So when people are afraid that this is not a good thing, being an election, more uncertainty, when you look at the data, that's not what we're seeing. You're seeing that you have better odds than in general to see a positive year than a negative year in an election year. So it doesn't seem very scary just because it's an election year that the market's going to drop. That's not what we see in the data. But we do have these 4 negative years. And the question is, can we learn something from looking at these 4 negative years? And the first time that we saw this negative year was in 1932, and it was Roosevelt versus Hoover. And that was an election year. But I also want to remind folks that 1932 was also the year of the Great Depression. So we had the Great Depression and an election. What might have mattered more for the market that particular year? And then 8 years later, 1940, once again, we have an election and the market drops. But might I remind you, that was the year when it became obvious that we will have a world war. So we had World War II or the election. What might have driven the market down that particular year? And then it took 60 years until once again we saw that negative outcome, and there was Bush versus Gore. And you remember the Supreme Court and the Chads with the gentleman looking through the little hole in the paper, and that was indeed it seems like there was all the way to the Supreme Court, a lot of uncertainty. It also turns out that 2000 was the beginning of the dot-com bust. This is when a lot of these stocks, the pets.com and all the other ones, start going down in value. So yes, we did have an election, but we also had the bust of the dot-com era. And then obviously the last time was in 2008, and that was the great financial crisis, which certainly had more to do with the market drop than the election. So what's interesting, folks, is that if you look at the election years, the overwhelming majority of the time, 20 out of the 24, the market goes up in an election year, but 4 years it did go down. And in each one of those 4 years, what is very apparent is there was something a lot bigger going on in the world rather than the election itself. And I'm not suggesting by any means that this is going to, this year is going to be a positive year or a negative year. We don't know at this point how it's going to turn out. All I'm suggesting is that as an investor, I wouldn't panic. I wouldn't be worried about being an election year as a detrimental factor to the stock market. That's not where we see in the data. Again, that's not what you hear on the news. I think on the news, a lot of times you hear the doom and gloom, and then this is an election year, the markets don't like uncertainty. That's not what we see in the data. So now, if we want to focus on those elections, and instead of kind of going back to the 20s, just to make it easier to comprehend, I also wanted to look at individual presidents, because all these elections resulted into an outcome in a particular president. So what can we learn about the presidents as it relates to the stock market? And I'm born in 1969. I'm about to be 55. And in my lifetime, I can tell you that the average growth per year in the market on an annualized basis has been about 10%. So let's use that as sort of the yardstick. 10% per year annualized has been the growth in the S&P 500 in my lifetime. So now the question is, how did the market do during different presidents? What can we learn from that? And again, instead of going to the 20s, I'm just going back to 69, which is the year when I was born. And it's quite interesting because when I was born, President Nixon, Richard Nixon, was in office. And for the 5.5 years or so that he was president, the market, in fact, did not go up. On average, annualized during the 5+ years that he was in the White House, the market actually dropped by about 2.9%, which is quite interesting. Again, the long-term, it's about 10%. The market actually lost about 2.9% per year. And then he leaves the White House, and then for 3 years and change, President Jerry Ford comes along, and the market skyrockets over 20% per year annualized, a very high return. And then if we move forward in 1977, President Carter gets elected, and he goes in the White House, and for the 4 years that he's president, the market actually goes up above average at about 11.7% per year. And in 1981, President Reagan gets elected for 2 terms. And on average, during the 8 years of the Reagan era, the market goes up by about 15.8% per year. And then after his vice president gets in there for 1 term, President George H.W. Bush, and the market once again does very nicely, 13.9% annualized on average, followed by President Clinton. 8 years in office, the market goes up by about 17.6%. And then we had President George W. Bush, and he's there for 2 terms, 8 years. And on average, during the 8 years that President George W. Bush is in the White House, the market actually drops by 4.4% per year on average drop. And after he leaves, after 8 years, President Obama comes in, the market actually goes up about 16% per year. And then President Trump, the last full-term president, 1-term president at 15.2. So the reason I bring this up, folks, is that when you look at the data, and these are the numbers, the question is it obvious that having a Republican or a Democrat in the White House is better or worse for the markets? And I've asked this question to audiences from conservative areas to liberal areas, and pretty much across the board. Nobody acknowledged the clear pattern that having a Republican or a Democrat in the White House is better or worse for the stock market, for the S&P. It just doesn't appear to be the case. And then leads to a second question, which I think is so important, which is, should presidents receive credit or blame to begin with for what happened in the market while they're in office? And I'm going to start with President George W. Bush. The reason I start with him is because one can look at this number and say, well, he wasn't very good for the stock market. He wasn't a good president for the market. And I would be like, taking a step back and say, first of all, President George W. Bush, and particularly tax accountants can remember that, he passed or he supported tax cuts to long-term capital gains in the stock market, tax cuts to dividend rates. So very business-friendly, very investment-friendly per se, and yet the market dropped by about 4.4%. And I'm not sure that it's fair to say that President George W. Bush wasn't good for the markets. Why? Because he walked in just as the .com was going bust. How much did he have to do with the .com going bust? And in reality, not much at all, because they had nothing to do with that. 9 months into his term, 9/11 happened, and then he walked off at the very bottom of the financial crisis. So should he get blamed, say he wasn't a good president? I don't think it's fair at all. On the other hand, you have President Clinton, and it turns out that President Clinton came into the White House just as the .com was taken off, something that I'm not sure that again the administration had much to do with, and talk about market timing, left just before it started dropping, so it didn't reflect on the annualized return of his presidency. And to me, the ultimate resolution here is that the same way there's not a clear pattern that tells you that having Republicans or Democrats in the White House is better or worse for the stock market. I think I would not try to assign credit or blame for how the market did during somebody's tenure, because it does not appear to be a fair game. There are things that might have happened before, things that might leak over the next presidency. So I'm not sure that I would tie that in. So it's very interesting. Now, you can also say, well, certain presidents come in with much more business-friendly policies, and that should matter. And one that comes to mind quite a bit is President Reagan, because he came in with the idea of supporting business, tax cuts, a lot of policies towards economic development. So in that respect, one investor can say, maybe it's time to put money in the market because we have a president that's very business focused. And if you look at the average growth in the stock market per year during the 8 years of his administration, it reflected that. It was a very positive outcome, 15.8% annualized return per year. So one can perhaps find evidence that having a president that is business friendly is good for the market. I've also seen in my tenure as an investment manager, I've also seen investors being very wary of a president that is not necessarily focused on business. What if you have somebody who is talking about social programs much more than is talking about business, economic growth, tax cuts, and other incentives for the economy to grow? And the person that comes to mind, it's in recent years, is certainly President Obama, because his signature accomplishment and what is talked a lot so much, he's talked about the social programs, the healthcare industry, and how to support people on the healthcare front, which is a social issue and not as much an economic one, at least not obviously an economic one. And I've seen enough folks kind of saying, well, if we have somebody who has more socialist views, the market's going to tank. Again, I need to sell everything and move somewhere else because the market's not going to do very well. So the question is, how did the stock market do when you compare a President Reagan focused on business tax cuts versus a president that is focused on social programs like healthcare? And what's interesting, again, when you look at the data, when you look at the numbers, what you see is that on average, during the 8 years of President Obama's time in office, the market went up by 16%, which is virtually identical to President Reagan. So when people are saying that oh, this president's going to come and it's going to be a disaster for the market, that's not what the data suggests. Not at all. It seems like the markets are not driven by the economic policies of a president, because whether we have tax cuts or Obamacare, the markets did pretty much exactly the same. And I think it's a really important consideration not to let emotions drive these decisions. When we look at data, we looked at data so far. When it comes to picking favorite sectors, it doesn't seem to make a difference. When we looked at election years, it doesn't seem to make a difference. When we look at presidents and their policies, it doesn't seem to make a big difference. And you can also look at a bit of like a deeper level, because so far we looked at data pertaining to presidents or individual case studies or election years. But what if you consider Congress as well? Because it's not just the president that matters, but we also have a Congress and policies and laws coming from there. And what's interesting is that quite often there is a split government when one party controls the White House but not the Senate, and vice versa. And in those cases, it's really hard to disentangle a political party from the outcomes of the market. But what's fascinating is that in 2021, I don't know if you remember that, folks, but in 2021, there was a special election in Georgia in January. And in that special election, the two Democrats won. And at that point, it gave the Democrats a control of the White House, the Senate, and the House, meaning that they had something called unified government control. And back in 21, it just really triggered this idea that you can now have a pretty natural experiment to look at. What if a party is in complete control of the policies in Washington? So they control the White House, the Senate, and the House. And you can look if there are periods when one party controlled everything in Washington, the agenda in Washington, and you compare with years when the other party controlled everything, well, that would be a pretty clear evidence of which party might be better or worse, because you get it. You have the White House, the Senate, and the House in control of the same party. So back in 21, I ran this experiment, and I wanted to go back for the 100 years of data to see if the Republicans had this unified government control. So when we go back to the 1920s, what you see is that over this time frame, the Republicans did indeed have this unified government control, and they had it for 13 years. So 13 years, the Republicans controlled the White House, the Senate, and the House. And if you just think a simple average of these 13 years, not an annualized, but just a simple average, and just mathematically, it tends to be a little bit higher than the annualized average. But when you take this average of these 13 years of the Republican controlled agenda in DC, you see that the market went up by 14.52%. So really nice growth in the stock market during these Republican years. Now, the question is, did the Democrats also have this unified government control? And the answer is yes. And in fact, if you look over the same time frame, it turns out that over this 90-plus year period, the Republicans controlled the agenda in DC fewer years than the Democrats. The Democrats did not control the government agenda for 13 years, but rather 34 years, so significantly longer. So the question is now, how did the market do during the 34 years of Democratic unified government control? Because in a way, that is the ultimate test. Which party is better for the market? And this is a very sensitive number because, again, I'm aware that some people might read, well, you're trying to promote one party versus the other. I'm not here to do that. I'm not here to make you feel good or bad about your views. I'm just here to look at data. And in fact, we did engage the folks in the research group and the PhDs just to run over the numbers, make sure that I don't get anything off. And it turns out that everybody came with the same result. And what's interesting is that over the 34 years of the Democratic unified government control, on average, the market during those years went up by 14.52%. It is identical to the second decimal. That's how little it matters who's in DC versus what the market does. 14.52, it's identical to the second decimal, which is a bit crazy, but that is the data. That's what the data is suggesting, that when you look at whether you have Republicans in control, whether you have Democrats in control, it does not seem to make a difference for the market. But that's not what you hear on the news. That's not how people feel. Most people feel, but of course it can be true because the Democrats or Republicans are better or worse. That's emotions talking, folks. And I'm here to tell you again and again, when you look at data, and we looked at data from so many different perspectives, we looked at individual companies or sectors, doesn't seem to make a big difference. We looked at election years, doesn't seem to make a big difference. Presidents, their policies, whether you have unified government control or not, it doesn't seem to make a difference. And all of this leads me to sort of the ultimate punchline, which is that elections and politics are very emotional. I don't believe that they should form the basis of an investment decision and making moves with your money. But rather what I believe is that politics and elections are certainly relevant to markets and companies. I'm not saying they don't matter. What I'm suggesting is something a little bit different, is that when you look at the performance of the company, you take Apple, you take Google, you name it, any company out there, their main value is driven by what they sell, by the profits they make, by their earnings. That's what drives the value of any company. So when you think of a company and what matters in terms of the profits they make, and I'm going to use the well-known Apple, what do you think matters more? The products they have, the services, the strategy, how they execute, what competitors do, or who's in the White House? The main value of a company comes from profits, and the main driver of those profits are things that the company controls itself. And quite often we see companies adjusting to different policies, but ultimately what I'm here to tell you is that politics and elections are one of the many, 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 many variables that impacts the performance of each company and the stock market as a whole. It just doesn't appear to be a primary one. It doesn't appear to be a variable that you can link and say, well, this is going to happen, that's the move that I should make with my money. Not at all. It's one of the many, 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 many variables. And the way that I thought about it recently is baking cookies with my daughter. So we're baking cookies, and then you put in the egg and the sugar and the flour and the butter, and you mix them all in. You put them in the in the oven, and when the cookie's baked, when you try to open it up, you can't really go and point out and say, aha, I can see the egg yolk in here. No, you can't. It's baked in with so many other ingredients that it's indistinguishable. That's what politics is. It's the it's the egg yolk in the cookie. It turns out that it's not the garlic in the cookie. It's not something that makes this thing so badly that you recognize. It's more so politics, more like the egg yolk in a cookie rather than the garlic in a cookie. And because of that, again, what we see over and over and over again is that people tend to make emotional decisions. They're not based on data. What the data is suggesting is that elections and politics are not a primary variable for the market as a whole. And because of that, what we're suggesting is that people should maintain an asset allocation and investments based on their financial plan rather than how they feel about the outcome of an election. Because I can tell you that whoever comes in the office and the White House, companies will find a way to make it work. That's the fundamental premise. I don't care who's in the White House, companies will find a way to make it work. And that's sort of the ultimate premise, is that free markets, companies find a way to make money irrespective of who's in the White House. And that's, in my opinion, what these numbers are suggesting. So with that, Adam, maybe turn over back to you and see if there are any questions or comments. I'd love to just answer whatever might be on your mind or the audience's mind.
Thank you, Apollo. This has been great. If anybody has any questions, please submit them. This is being recorded, so it will be made available to anybody to review at a later date as well. As of now, there are no questions. Let's just give a minute. You covered all my questions. Very, very informative. No, does not seem to be any questions coming through right now. Okay. I think we'll close it there then. Apollo, I want to thank you so much for your time. This is extremely informative. Thought it was great. And look forward to doing it again with you sometime down the road.
Me too. Thank you so much for the invitation, and thanks to everyone for taking the time.
Thank you.
Bye-bye.